Hello, this is Bill Moreland with Bank Reg Data. Today I'm going to review Northepoint Bank out of Grand Rapids, Michigan. This is a $6 billion bank right here. And up here on the left, I got their website, Northepoint Bank. They recently went public. Their first trading was early, mid-February of 2025. I'm picking this bank as part of our quarterly mailings that go out. This is kind of the good, the bad, the ugly companion video to that. There's nothing magical about Northepoint. I'm not an investment advisor. This is not a buy or don't buy. The idea behind this is to use Northepoint as a vehicle to how call reports can be used to supplement your bank reviews. So we know that they're publicly traded. We can take a look here on the right-hand side. We can take a look on the right-hand side. Northepoint Bank has basically gone through a lot of asset growth. So just off this main page, there's a lot of clues, a lot of hints of information. One, they've gone from just under $4 billion in assets to almost $5.9 billion. But notice the big jump here, 5.22 to 5.86. That is a big. And so this was the period where they were private, that they were going public. So this right there would have been their first call report as a public entity. So growth is important, right? You always got to ask yourself why. Why does a number look the way that it does? So large growth pre, and then exceptionally large growth post IPO. The second thing that should catch your eye is the number of FTEs. We can see that they've gone from 1,266, all the way down to 492. So this tells me a couple things right out of the gate. I'm betting that they're a mortgage banking activity bank. They're probably a primary, and I know this is the case, but just going in, you could guess, based upon that large number of FTEs, they were probably ramped up for mortgage banking activity, servicing, underwriting, refinancing, new loans, the whole deal. So if we come back over here to the left-hand side, what's interesting is the first thing we see on their splash page. Well, look at that. I just updated it and it basically went back to you want to buy a home. But you saw it. It was there. It was, do you want to come get a CD? So that's interesting. That's very interesting. That's fascinating. I started writing this article on Monday and Tuesday, it takes days to write these things. And on Monday and Tuesday, their splash page looked just like this. And then Wednesday, it flipped to come get your 4.25 11-month CD. And so whenever you see that, I swear it was there. You saw it. It was on video. Whenever you see that push for a CD, that tells you a liquidity thing. But it wasn't actually there. On Monday and Tuesday, the funny thing about this is it was literally, do you want to buy a home? So this will go a different path, but let's take a look at them, right? So the first thing they're pushing is come get a mortgage, track your mortgage. This is their main page. And then you come down here and convert your home into home equity, path to home ownership, qualifying with non-qualified mortgage. You come up here, you basically see, what do you see? All right. So they have a health savings. They have an 11-month CD special. And there it is. That was what was on their main page, was that big special as they were pushing. But you come back and you look at all the home lending. This is not your typical community bank. This bank is all in on lending. So the one thing is you could basically see they have tons and tons of options. And we'll talk about this. But first of all, it looks like they operate in multiple states. Whereas over here, they got one branch. A $6 billion bank, one branch. So clearly it looks like they're doing mortgages now on a national basis. But look at all the programs they're running. Delayed financing, temporary buy down, rate refresh, that makes sense, right? Launch down payment assistance, come down a little bit more. Non-warrantable condominiums, FHA loans, there's home equity loans. So there's a number of things here that basically they're very creative in pushing mortgages, right? So this gives us a pretty decent idea. Another thing to notice is their executive team. Charles Williams has basically been there since the very beginning, 1988, and I think their first call report was in 1989. So they got very consistent management. Kevin Comps is essentially their president, but he came back in 2017. And so this little history lesson that I'm going to give you will mark some things that we're seeing. And realistically, what's happened is they basically have had a change. And I'll bring up my email. It's going to be going out here shortly. And this email will highlight a little bit easier here's the total assets. And on the right-hand side, we can see that it's grown. But look what's happening. There's 2017, right? And so I think something changed when Mr. Comps came back into the organization as the CFO, and he subsequently was promoted to president right before it went public in late 2024. But you can see that for a long time, they were just your typical community bank, $260 million in assets up to $600 million as they were recovering, and they almost went under. If you go back to the GFC, and they're not the only bank, there were a lot of banks like this, but they had a Texas ratio in excess of 200. They had non-performing loans of 6-7%. They had restructured debt that was left off non-accrual in excess of 9, 8, 10, 9, 11%. They had Tier 1 capital sub 7, so they had a 6 handle on the Tier 1 capital. So they were struggling come out of the GFC, and they spent that time consolidating, doing a really good job of rebuilding it, becoming profitable, working through a lot of the issues. Then we can see in that 2017 period, the assets took off. They went nuts. And then from 2017 to 2022, they basically had one trajectory. And then in 2022, they were stable. And then they had another trajectory going into the IPO. So we understand why they're doing this, right? They went all in on housing. And so let's come over here and we'll take a look at loans 2012. Here are the loans growing. And this is just a direct mirror. And you see this enormous $700 million dollar increase right there. One quarter, $757 million increase. And if we come down and we take a look, we see their delinquencies have gone up and remain stable. But this is an important note. Now, to their credit, they're not doing any loan modifications. Their loan modifications are fairly negligible. I mean, very, very tiny. So kudos to that. But we can see that their delinquencies, realistically, they're going up considerably. But the delinquency rate right there is basically looks like it's flattening out. And so this is an important distinction to understand is when you look at a ratio, look at the numerator, look at the denominator. You can have a delinquency rate that technically goes down. The delinquency rate dropped 9 basis points. Hey, that's great news. But it didn't. The delinquencies actually went up $14 million. So this looks, for those of a certain generation, of which I'm one, this looks a lot like what happened in 2006, 7, and 8, right? You're growing the numerator, you're growing the denominator faster than the delinquencies. But as you add more loans, potentially you're creating another wave of delinquencies because it takes about 18 months for those delinquencies to hit. Let's scroll back down and let's take a look at their loan mix. And so what we see here, this is fascinating. They are $2.5 billion in all other loans. And the non-performing loan rate is 90 days past due plus non-accrual. And so what's going on here is those are all NDFIs. And it's very confusing as to what the NDFIs are. These are non-depository financial institution loans. If I click on them, you can see massive increases. And they don't hit schedule. They're not reporting the NDFI detail, which in some cases is not very helpful, but it tells you if it's private equity or business intermediary or consumer intermediary, but they don't reach that threshold, which is kind of silly because realistically, this is the 42nd largest NDFI portfolio in the country. But because they're sub $10 billion, they don't report, which I suspect the FDIC or FFIC may reconsider that and go towards a mortgage banking activity. This is Schedule RCP. And the way they do it is larger banks of $1 billion or if a bank has 2 consecutive quarters of more than $10 million in that activity. So this is a really clever way of doing this report. So you could have small banks that are heavily involved in this activity, but they would still report. What we're seeing with the NDFIs, however, is it's just a straight $10 billion threshold. So I suspect, well, there should be. They should revisit that and come back and give us an idea. So the problem is we don't know what this is, but we do. And I can tell because if I basically come back here, this is their IR. So if I go to their normal site and I look at the IR, basically there will be some, they'll talk about this. They'll talk about everything is coming on, but essentially there's a section in here where we talk about they talk about MPP. So MPP is basically their mortgage purchase program. And the MPP basically, it drives a lot of what they're doing. This is a heavy mortgage lender. And so you can see their MPP fees were 1.1 million, a decrease of 453. But essentially what we're talking about is that there was a significant increase right there. Gross loans held for investment had an increase of $719 million. But nowhere do you see an increase of $719 million anywhere. There's not, look at the home equity, except for that $700 million increase right there. So I don't know what these are. They're mortgages. They're mortgage purchases. But it looks like they're basically doing non-depository financial institution classification, even though they're mortgage loans. So it's a little bit confusing. But whenever you see this all other, read it as mortgages, because that's exactly what the numbers basically represent. And they say it, and that number, as it goes up, it does come from that. Their 1 to 4 family first liens are their second largest portfolio, but realistically, we know that's all mortgages. So this is an 80% bank exposed to mortgages. And we see the non-performing loans, 90 days past due plus non-accrual, are at 3.56. We see the home equity is at 1.62, construction loans. So as you start to cycle through here, you see that every single portfolio has got delinquencies in it. Now, the problem with looking at banks that are like this, and it's all banks, but whenever you look at their mortgages, you basically have to ask yourself right out of the gate, is it guaranteed? Is it guaranteed? What are they on the hook for? What are they not on the hook for? Now, that doesn't mean there's really 2 things going on. So you can see that they're shrinking that book, even though they're growing it through the MPP program. But if we come in and we look at the delinquencies are getting worse. It's now 5% of their book. So whether they're responsible for it or not, this tells us something. This tells us that the mortgages that they've underwritten are starting to have significantly large cracks in them. Whether they're responsible for it or not is not the issue from a macro perspective. But you come in and you take a look, there's your delinquencies on home equity. But look at the home equity loans. I mean, this is crazy. That is a $500 million increase on a $275 million base. And so is it any surprise that the delinquencies are going to follow, right? And so come in and look at construction loans. Now, this is one that is kind of moderating, but take a look at the exposure. They're getting out of that business big time. So go back to delinquencies, come down to juniors. So they grew it. It's kind of coming back down a little bit, but look at the delinquencies. They're skyrocketing. Take a look at construction, yet another housing-related portfolio. They grew it as the government was raining money. They're quickly getting out of that business. I mean, they're dumping that business. But look how the delinquencies continue to climb. So every single portfolio, other than the non-depository financial institution MPP loans, are having tremendous delinquencies. So we come back in. This is going to be where the guarantees are going to be. So on the left-hand side, I'm going to asset quality, and I come in and I basically take a look at government guarantees. And so the government guarantees, essentially would show up right there. How many are 30 to 89? How many are basically 90 days still accruing fee and interest? How many are on non-accrual? So to their credit, this is good. This is what is supposed to happen. If you are managing a government guaranteed portfolio, SBA 7, Ginnie Mae, if you're servicing those loans, you're supposed to treat those loans exactly the way you treat your own book. And typically late stage delinquent loans aren't kept on 90 days past due accruing fee and interest. That said, almost everybody else would put that 29, 30 million bucks right there, and they would earn interest and fee income. So from a taxpayer perspective, I'm not fond of that. As a, hey, look, I'm a banker. How do I take advantage of this opportunity and maximize it? I would tell them, you really should probably do what every other bank is, and I could find you a lot of examples, and move them to 90 days past due accruing fee and interest income. That would help prop up their net interest margin, which we'll talk about a little bit later. So if we look at aggregate NPLs, we don't know at RCC level. That's where these come from, is Schedule RCC, Part 1, which is loans, and then RCN for delinquencies and charge-offs in RI. We don't know guarantees. We only know guarantees in an aggregate. So I'm going to look at asset quality aggregate NPLs. This is what we've already identified, is they're having their delinquencies are increasing dollar, and we basically see that their rate is actually dropping, but we know why, right? You just grow the denominator. But we see of that $87 million, they basically have a good chunk of guaranteed loans, and their net is $56.85 million. So whether you look at the gross from a macro perspective, or you look at net from a, hey, what are they responsible for? The numbers are both going up. But we can see very clearly this is what they are responsible for. And so the big issue with this particular bank, and we're going to get into good things, and we're going to get into, some things that are not as potentially as bad as this, but this bank has got delinquency issues at a pretty high level, and they're deteriorating. And what really should be a discussion point is we really don't understand what this is. And I'm a risk guy. I ran shops. I built teams that did underwriting, that did authorization decisioning, in a lot of areas. I mean, credit, checks, consumer, business, debit, payday lending. I've done a lot. I've actually ran collection shops. So I've built and managed teams that did the collection. So I'm a risk guy. I look at the world through a lens of risk, which is both a blessing and a curse. So when I see somebody basically add $2 billion of loans in 3 years, I'm skeptical. And what should really be worrisome is, do they hold as much capital against these loans? Do they hold as much reserves against these loans? Or do we get advantageous RCR risk weighting by having them in NDFIs? And so I'm skeptical of this. Now, we do have delinquencies now being reported on NDFIs as of 2 quarters ago, and we're not seeing anything, right? We're just not seeing them there. But I wouldn't expect the new ones to have problems, but I'd expect some of the other ones. So I don't know this. I would suggest that, more work needs to be done in trying to determine what exactly those loans are. But when I look at these numbers over here, and I go to their Q1 10Q, that's their press release, it is $87 million gross, 56.853 net that they are responsible for. So just off their base portfolio, we see that there is a deterioration. And it shouldn't be as a surprise. Housing's going to start cracking, right? We're seeing that anecdotally in a lot of areas. If you come over here, the main point to take away from the bad section or the ugly section is they're just not reserved. So if we come in and we take a look at their adjusted NPLs, which is that $56 million there, which is that $56 million right there, and we compare them to the reserves or allowance, This is a coverage ratio. It says, for every dollar of adjusted NPLs, you have 80 cents of essentially allowance. Here, for every dollar, you have 22 cents. So there's contextually a lot of ways to look at this. Just in the last 3 years, it's down 75%. And another way to look at this is 3 years ago, you had $17 million of allowance and it fell to 12, and it's been at 12, 12, 12, 12, 12, 12. 3 years ago, 2.5 years ago, you had 18 million of adjusted NPLs. It went to 24, it went to 56. So remember, this is leading into going IPO. How do you get a negative? How does allowance go down? Well, allowance goes down because of charge-offs. Were they taking some charge-offs? A little. They've got remarkably low charge-offs. And they'll talk about that. We've got incredibly low charge-offs. But you got a heavy, other than HELOCs, you have a portfolio that's heavily REO backed, right? There's a real estate component. But that 2 basis points, if we come down here, it's in the top, 20, 25%. So their charge-off number looks good. But how do you get an allowance number that keeps going down if there's no charge-offs? Where are you getting a lot of recoveries? And we can go in and we can come here and we can look at recoveries. Yeah, maybe a little bit there, but you're not getting a lot of recovery. So allowance is a bucket. And at the bottom of the bucket is a hole that's charge-offs. And at the top of the bucket is 2 funnels. One is provision and one is recoveries. And so if we look, they're not getting, other than that number, we're not getting a big dump in recoveries, but we're not getting a big takeout in charge-offs. So how is the number going down? What's provision? So you go to income and expense and you go to provision. They're taking out a lot of provision. They took out $500,000 of provision pre-IPO. And the reason they're doing that is to prop up their pre-tax net operating. You want to show an increasing pre-tax net operating going into your IPO. So how do you do that? You start to take money out of provision to prop up the income statement. So if we go back and we do switch to year to date, and we look at full 2024, which is the aggregate, we see that it's $1.5 million was taken out in 2023. And really it's more than that, because there should have been contributions going in every quarter. But when you see a bank consistently take money out of provision, it isn't just the money that's being taken out, it's the money that's also not being put in, right? So we're looking at probably $2 million, $2.25 KISS to earnings income. And then we see in basically Q4 year to date. So it's going to be the year to date of all those. In 2024, the benefit was $328,000, but it's on top of that, right? So that's probably $600,000, $700,000. So we see a consistent pattern of this bank taking negative provisions. And then they put a ton of it back. Well, this always drives me crazy. Why are you taking $500,000 out to immediately give it? Well, come on. We've all worked. If you've worked for a public company, there are lots of ways to manage your earnings. And this is one of the ways that publicly traded banks do it, is they basically will manage it as a kitty. But coming over here, looking at this on the right-hand side, basically it's down from 80 cents, which is horrible. 80 cents versus $3.46 for peers. Who are the peers? The 99 closest banks at that point, the 99 closest banks at that point, et cetera, et cetera, et cetera. So peers were considerably better reserved as a group. Now, they're lower reserved, considerably lower than what they were just 2.5 years ago. The second thing to look at is that 22 basis points, 22 cents is the lowest they've probably ever been. I mean, look at that last 10 years. That coverage ratio was never. And back prior to this 2020 timeframe, they looked like a normal community bank, $1, $2 in that range right there. The third contextual data point is to look at where they're all at relative to today's $6-7 billion banks. They're the bottom by far. They're the bottom. They're in the 100th percentile. Now, the one final observation, and some of you probably have already identified it, is Look at the peers. We've gone collectively. That's the industry as a proxy of banks their size, not including them. It's all the other banks their size. Look how less reserved the community bank segment is becoming just in the last 2 to 3 years. 3 years ago, we were consistently at 350, right? 370. And now the number's down to high twos, to low twos, to 1.5. So the industry from a macro perspective is becoming a lot less reserved. And especially this slice of $4 to $7 billion banks that are their peer group. So these are kind of the main concerns, but let's go back and take a look at their ability to generate income, okay? So we've already identified that they're probably a big mortgage shop, a lot of employees, down to a few employees. And if I remember right, this 492 is like the lowest they've been since 2017 timeframe. Once again, that number, 2017, is when their CFO came back and it looks like they shifted their strategy. But we can also look at the mortgage banking activity. And so the mortgage banking activity is Schedule RCP, and we can see that they were doing, huge multi-billion-dollar sales. And that's what's remaining. That's what's sold. Here's what's originated retail, originated wholesale. And so what this is this is going to tell you that they're generating a lot of non-interest income. And so we can go look at that. So on the right-hand side, I'm going to keep mortgage banking activity up. On the left-hand side, I'm going to come back to income and expense, and we're just going to work through this. They were very inefficient. Well, yeah, because they had a lot of employee staff, but they were generating a ton of non-interest income. But their operating income was, if we go back to 20 and 21, they were making a lot more money, and you see that here, and we'll see it shortly. But as rates started to climb, and that's the deal, every metric we're looking at is driven because of interest rates. This bank is example 101 of how a bank could respond to the Fed. And when the Fed went to zero, this bank took their mortgage refinancing and their mortgage underwriting and their servicing shop on steroids. It unbelievably levels. They're very lent out. You can see they're being very lent out by looking at the balance sheet. 5% cash, absolutely no securities, 91% net loans and leases. You click on the 91% loans and leases. You look how high that number is. You look how high it is there. You scroll down here, number 1. This is the most lent out bank in America, and it's all mortgages. It's all mortgage related. So what they were doing is they were responding to rates going down. Then when rates started to go up, they weren't making as much money as they were in 2020 and 2021. So then what did they do? They started firing employees, and they started to get their income number. Look at the expense. They were rocking $60 million, $59 million of quarterly FTE expense. The number's down to $29 million. So, and that's non-interest expense. If we look at the subcategory of salaries and benefits, it's 42 to 20. That's people being hired. That's people being fired, right? And that's fine. They're responding. It's capitalism, but they're responding to the Fed. And so their efficiency ratio becomes problematic for peers, right? This is really not a bank that anybody would want as a peer. But now all of a sudden, they look incredibly efficient. And so their efficiency ratio is being driven by this. If we look at what they were paying their employees, there's, I guarantee the average person wasn't probably making $230,000 and $200,000, but that's fine. This is all in bonuses, salaries, everything averaged out. But you can see the extraordinary income that was made per FTE in 19, 20, and 21 when rates went down and they basically skyrocketed. 2022, those income numbers went way down. The only way they could react was just to start getting rid of staff. So that's one reason that their efficiency ratio is getting better. But going back to the mortgage banking activity, come in non-interest income, and we'll just start working through this. So whenever I look at this, it always gives me an idea of, have they maxed their earnings potential, or not. So when you don't see any trust or fiduciary, that means that they've got an opportunity to grow a business, to add income, to generate down the line. And how many banks have fiduciary? Their size? 45. 45 banks. So 55% of the banks, their size, are not doing trust and fiduciary. Are they generating any income out of service fees? So they're not, and I know why. We'll come back to it. But when you see this is NSF fees, stop payment, service fees, account fees, they're nothing. I mean, they're zero. And you come down to the bottom, they're in the bottom. So this bank is, if you're a customer of this bank from a perspective of fees, they're a very good bank to do business with. But from an investor's perspective, that's two now areas where a management team could come in and start to drive more non-interest income. Servicing's the big one, right? So this is where they were driving very large service income. And we can see going back here, this has been a big driver of their 2017, and they recaptured a little bit of it in 2020. And then it's just been going down since then. And we can see they actually took a big hit right there. So servicing was a big driver, but the big one here that's catching your eye is loan sales activity. And so when you look at the loan sales activity, this is a reaction of rates. When rates go up, those portfolios that they're working aren't going to be, right? And so they'll start to sell them. When you start to see negative losses, that means that the market's valuing them differently than what they've got them on the books. So when we come into income and expense, and we go back to pre-tax net operating. So this is going into IPO. Notice that these numbers here, here, and here correspond with big drops and losses. So their pre-tax net operating income is almost exclusively driven by their non-interest income, which is basically their mortgage business, their servicing and loan sales and underwriting. There is another expense down here in the other income, so you see this drop right there going in pre-IPO, clean those books. I have no idea what that is, but you see how they took an extraordinary gain in Q3. It had a big benefit. They took a big loss in Q4, which had a big benefit. But it looks like if it's me, I'm cleaning the books going into the IPO, right? To make my first quarter a really good IPO. But I don't know what that is. I don't know if it's going to be released because they wouldn't have been publicly traded at that point in time. So this bank has a couple of things. Their model doesn't work as well in a non-0% interest rate environment. So we've actually now got to go back and look at their ability to generate net interest income. So how do you grow this much? How do you grow that much assets? And they're all loans, 91% loans, right? We already identified as 91% loans. So how do you feed that loan machine to grow and grow and grow? You got to have funding. And so if I come in and I look at core deposits, I see that the number for the most part didn't do much 3 years ago versus 2 quarters ago. Now there was a drop and there was an increase, and this is Silicon Valley Bank, right? That's the time frame where they didn't want to pay grandma. And I mean, it's retail, right? They're not probably paying competitive rates on retail. They were losing core deposits. That's flipped. But net, 1.2 billion, 1.2 billion, 1.2 billion, there ain't nothing there. Now we can see that number climbed, which goes back to my comment about, it's back. All right, so it looks like they're rotating it, but then it's there. That's it, right? That's the splash scene. So you can look at their website and know exactly what they're doing based upon looking at their call report data. Just management making decisions. We got to get more core deposits. Well, why? But look at this. Core deposits are at 23% of assets. How low is it? Well, peers are at 70, 80. All right. What's it? So there's that 2017 time frame, and then their strategy changed, right? So I keep coming back to that time frame. Something changed in that bank strategy. They didn't want to be a small community bank growing anymore. They wanted to ramp up into a much bigger organization. And mortgages were the way to do it. And they timed it perfect. But core deposits at 22%, XD is Beal. That's one of the new Beal banks that they spun off out of the holding company. And that's just a whole nother animal. But look at that. They're in the 99th percentile, right? So this bank has no core deposits. So this is why when you come over here and you look at their splash page, that you see that they're pushing bring in, bring in, bring in. So if core deposits are going down, how are they basically growing assets? Well, only a couple places. So we go to deposits and we go to brokered and we see it. So the brokered deposits have gone from $1.1 billion to $2.34 billion. They've gone from 47% to 60%. The number is so ridiculously high. So contextually, all the other banks their size are sub 10. Go down here, look at the massive difference across time. They were sub 10. But starting in that 2020-21 timeframe, they went in all in on brokered deposits. Where are they at nationally? Bottom third, right? Bottom 98th percentile. And the other two banks, once again, is that Plano, Beal, XD Bank, and then Comenity, which is a credit card bank. So this bank is maxed out on brokered. So the question that you have to ask when you look at this is, are they getting a cap? Are they getting a reciprocal cap? Because they could be running a lot of deposits through an IntraFi type of network, but we're not firing it. I would show you right here in this upper box where it says broker deposit ratio with the big 60.7, that would disappear and there would be a reciprocal broker deposits flag to tell you they're not doing this. These are brokered. So they're not paying grandma. Now they're trying to pay grandma now, but I'm guessing that they didn't pay grandma at all. But if she went out and basically went to her Schwab account, that's where she was getting. This is very standard. This is not a value statement on the strategy. It's just that's the strategy. The strategy is we're expecting this rate thing that's normalized. I think it's normalized. A lot of people think it's abnormal. Depends on how old you are, I think. But they're betting that the Fed is going to They're betting that the Fed's going to drop. But you notice the numbers started to go back down and now started climbing. So core deposits are flat to now up. Broker deposits are maxed. How else are they getting financing or funding? FHLB. And so you can see they were using FHLB in conjunction to broker deposits. Did they do any BTFP? A little. Not much. I don't know if that's BTFP money or not. It could have been something else. They did have some subordinated debt, and you could see that they had $15 million of subordinated debt, and they were paying fairly rich on that. We'll come back to that shortly, but that's rare to have subordinated debt. You come down here, you see only a handful of banks, 3, their size even have it. Doesn't mean that it was a bad thing or not a bad thing. It's just they at one point in time had taken $15 million. But the Federal Home Loan Bank is really where they rose a lot of their funding along with brokered. So core deposits are low, a lot of third party brokered enlisting, and a lot of FHLB advances. But it looks like they hit the wall. And where's 24, 26, 27%, 28%? Well, let's look at the 21. 21 in the bottom. So what I'm guessing, and I don't have any intuition, I don't really know how a lot of this works, but I think they hit the limit, right? I think they hit what they were able to basically go out. And the reason I think that they were being artificially capped at that 1.2, 1.3 billion is all we have to do is come over here and take a look at their funding costs. And you'll see exactly what you and I would do if we had these options. This is funding data, and that's going to be blended deposits. So they're paying through the teeth. I mean, 4.29, and sorry, there's what before right when the Fed was at max, and the Fed's come down, and you see their rates have coming down, but they're paying considerably higher than peers. So all in, but this is going to include almost all brokered, right? So this is what they're paying on core deposits, broker deposits, transaction accounts, money markets. It's difficult to look. There is no breakdown on here's what they're paying grandma core and grandma through her Schwab account. There's no way to know that. But the 429, 99th percentile. So they are paying a lot of money for their domestic deposits. But if we come over here and look at this Fed funds purchased, not Fed funds purchased, subordinated notes. We can say they were paying 7, 8, 10% on that 14 million, right? So I talked a little bit about that. These numbers kind of fluctuate a little bit, especially for the peers because they're so rare. But if you basically look, they're paying 8, 9, 10% on that money. So you can see why they wanted to get out from underneath that. But go back, brokered or total deposits of 429, 468, 507. We'll come over here and we'll look at the FHLB. The FHLB is under trading in other borrowed notes. So basically the FHLB, and I'll bring them up side by side, and you'll see that it's dollar for dollar. And this is one of the cool things about understanding how the call reports work. These are the FHLB notes, right? 275, 13, 13, 13, 12. This is we don't get FHLB broken out on the call report. It's not there. RI, RCK is your averages. We don't get that. But we get an aggregate of what their trading asset or trading liabilities and what their other borrowed money is. Well, they don't have any trading and they don't really have any other borrowed. The other borrowed is FHLB. So 1.258, 1.281, 1.20, 1.277. This is a 2-quarter average and it's not straight. It depends upon what the flow is at each point. But look at this. Look how low, 335, 339, 335, 360. And I don't know how these are set. It could be the quality of the collateral, right? It could be that they're all mortgages. It could be that they locked in rates lower. And so they had the benefit of that. I don't know. But look at the spread between what they were paying under funding dated deposits. If they could take more FHLB, trust me, they'd be taking more FHLB. So the bank now is struggling, right? So what all this means is their income and expense, their yield data is going to be reasonably good, high, because it's a lot of mortgages, right? And a lot of home equity loans. But their funding costs are extremely high. 3.6, 4.1, 3.9, worst in the country. Worst in the country, banks their size. So that means their net interest margin, and I'm going to go ahead and I'll switch this. I'll be generous. We'll do average earning assets, so it's a smaller denominator. They don't have any securities, but I'll adjust it to tax equivalent. You don't see really any difference in these numbers right there. But this is the most generous ratio combination I can come up with. How do they make money? They're 234, 237, 228, bottom 12%. And so the question is how does this bank make money moving forward? Because they don't have any core deposits. They're relying 100% on brokered and CD promotions and FHLB advances. That looks like that, that when we looked at that a little bit earlier, it looked like it was starting to go up, right? So it was starting to go up. It's higher than it was a year ago, higher than it was 2 years ago. Still advantageous, but not as good as it once was. How does this bank make money? And so realistically, they went through a big growth transition at the right time in housing. They capitalized on that. They made a ton of money, but moving forward, the model's a little bit broken in terms of how they generate. Everything was geared towards low interest rates for non-interest income generation, and the rest of the banking franchise really wasn't doing much. And the problem is their loans and their delinquencies are starting to catch up to them, right? And the percentages, that's an illusion. 2.4, 2.4, 2.4, 2.4. No, you can't look at that, because of all the growth and the denominator, and it's all NDFI related, which is their NPB. So there's a couple things really with this bank. I think they've done a good job, but unless rates go back down, I'm struggling a little bit to basically see how this bank expands income. I don't understand how they're going to do that. So let me see if there's anything else. I think I talked a little bit about, we can go into growth metrics. Another way to look at these is basically you can come over here and you can see what portfolios they're growing. There's that $757 million increase in non-depository. That's exactly what ties on their earnings report and Q1 release, as they said their chained MPP growth was $757 million. So this is the simplest way to understand. If we go back and we look at yearly, we can see that they're actually kind of scaling out of everything. There's your construction portfolios that they're dramatically getting out of. There's their mortgages. The ones they're growing is home equity, which I think is a sign of stress, right? When people start taking more home equity loans, it's a sign of stress. It's not a sign of a healthy consumer. And then you're basically looking at the delinquencies on that are going up tremendously. And then this. So this is the $1 million question. Actually, it's the $2.5 billion question. What is the risk associated with that? I don't know. And if I was an investor in the bank, that would be the single biggest question that I would ask is how does the bank make money if interest rates stay normalized and don't drop? And two, what is the risk associated with $2 billion of new growth, $1.9 billion of new growth in your MPP program? How is that risk mitigated? And why are we seeing coverage ratios that are historically low for you, historically low compared to your own history, and in the bottom 100th percentile? Virtually every other bank in America, their size, has more reserves. So I don't fully know what the answers are to that, but those would be the three areas that I would look at for this bank is what's the risk? How are you going to make money? What's the risk over here? What's the exposure? And how are you going to start setting aside more? Because the reality is, where's the provision going to come from when your pre-tax net operating earnings are so heavily dependent upon non-interest income and those numbers aren't what they once were? I mean, I don't see how they're going to increase. I'm going to take a look at capital. We did not look at that. So whenever you see a bank get to 10, they basically almost always will have to start raising capital, that percentage. And they're doing it. What were they doing it through here? Liabilities and equity. All right, surplus, right? So there's the earnings. There's the IPO, and that's where it goes in. Retained earnings are climbing and climbing, climbing. So they're clearly trying to get that, but retained earnings, that's elevated. They're getting that higher retained earnings, and they're getting that higher capital, tier 1 capital, because they're not basically taking provision. So it's going into one bucket, but it's because it's not going in the other. So you understand what this is, this big gap. They went to a community bank leverage ratio structure. This was a prior Trump administration deregulatory push. So they reported tier 1 capital because they were reporting RCR2, which had the components for risk-weighted assets. I don't really care for this. I don't like it. It makes it very confusing. But once they get to a certain size and then they transition over to 041 report, they don't have that option anymore. They got to report it every single time. So anyway, as always, if you have any questions, feel free to reach out and give me a call. Thank you.